Hello, David Moore with Equity Advantage, and today we're going to talk about a couple different things. We're going to talk about Section 121, the universal exclusion for a home sale, talk about 1031, which we typically do. We'll talk briefly about 1033 and then what falls in between. So I guess maybe the topic of this is what is your sale going to be considered? What code does it fall within? And understand that all these things can apply. Typically, we're looking at Section 121 or 1031. 121 took and replaced Section 1034 in the late 90s. And when it came in, it was a really great thing because instead of the old rule at one-time lifetime exclusion if you're 55 older of 125,000 in gain, we then had that replaced with something where if you lived in a home for an aggregate of 2 out of the preceding 5 years, you get $250,000 individually, or a married couple would get $500,000. That was very attractive in the late 90s value-wise, but if we go forward, 20 plus years, those exclusion numbers don't do much for a lot of people. So I would argue a lot of times that the old 1034 rollover where you sold a home, you had 2 years to buy a new home of equal or greater value is actually more attractive for people. But it's gone. So we have to look at a sale and understand maybe what it is and what you want it to be. Section 121 applies to any property that's been used, once again, as your primary residence for 2 out of the preceding 5 years. It doesn't mean it's being used as such at the time of disposition. So you could move out of a home, sell it within 3 years of moving out, you can still take that exclusion. Think of a situation where you've got a home well beyond gains on that home well beyond the 250 or 500. What can you do? Well, move out of it. Establish it as an investment property. Go buy a new home. Move into it. And now you're seasoning the old home is now converted into investment property. And after the appropriate period of time, you then could use 1031. Take the exchange, and you'd still be entitled, as long as you sold it within 3 years of moving out, to take that exclusion number. So we're going to look at a situation where, what is this property? What do you really want it to be? You want it to be a home, Section 121. You want it to be 1031. Maybe the home's both. Imagine a home with a home, even an issue, an opportunity, I guess, or a situation that comes up that people don't think about is, let's say you work out of your home. A lot of people do today. And your financial people have said, hey, look, let's treat the home office as a home office. You start taking depreciation on it and everything. And then a couple years later, you go to sell it. Well, what are you selling? You're selling your home. You thought it was all Section 121. But that home office is actually investment property and might need to be treated as a 1031. More obvious example might be a duplex, half owner occupied, half non-owner occupied, or a farm with a farmhouse and a working land. Allocations two different directions. So we can have a sale that could be 121, 1031, or a situation where it could be both. What happens if the government, somebody comes in, eminent domain, takes and condemns the property? Well, that's 1033. We've got a different set of rules there. So you've got to look at that. Now, what else could happen? What else? Maybe you've got a piece of investment property, defined property held for investment. What does that mean? How long does that mean? We've got a court case a few years ago where 4 months was deemed long enough. I wouldn't be comfortable with that. But, typically I'm going to say a year based upon a couple different factors. Ultimately, it's up to you and your tax people how long is long enough, and you want to have this conversation before you do it because you don't want your tax people to hear about it on April 15th when you're finishing your returns, hopefully April 15th. But understand there's a variety of tools out there. There's a variety of tax codes to use, and there's situations where you can combine them and use allocations to your advantage. And it all comes back down to good, competent tax people. You want tax people that you're going to be working with year in, year out. They're going to give you lots of opportunities. Dealer status stuff, lots of people want to flip properties. We've all heard the ads on the radio, seen them on TV. Well, what's that? They might argue, you might argue it's an investment property. It's not. It's dealer property. It's property held for resale. You're going to pay normal income tax on that. So a thought along those lines might be, instead of buying and flipping the thing, don't be that flipper that gives away all your profit. Be somebody, do a modified flip. Maybe you buy it, fix it up, rent it for a period of time. Maybe you pull money out, do a cash out refi, season the property as an investment for a couple of years, then do an exchange out of it. The money you got from the cash out refi really would be representative of what you would net after paying taxes, but you still have the asset. So that's something that works very well for people. But I'll throw it out to you. If you've got questions on any of these issues, please give us a call, shoot us an email. We're happy to talk to you about it. And our job is to keep your money yours and keep it working for you. And we're always happy to do that. So thank you for joining us today. And once again, David Moore with Equity Advantage, 1031exchange.com. And please don't hesitate to reach out with questions on these or any other topic you might have. And look forward to hearing from you. Once again, David Moore, Equity Advantage, 1031exchange.com. Thank you.